Welcome to Charged Alpha. I'm Hudson, joined by Lana. Today's chapter, On Semiconductor, the chip maker that placed a defining bet on silicon carbide power for the electric vehicle era.
On Semiconductor was spun out of Motorola in 1999. It spent its first 2 decades as a broad-based analog and mixed-signal chip maker, solid but undifferentiated.
The transformation began in February 2021 when Hassan El-Khoury arrived as CEO. He had previously led Cypress Semiconductor and sold it to Infineon for $9 billion.
His mandate was direct: pick a lane and win it. onsemi would become the leading supplier of silicon carbide power chips for EV drivetrains, exiting commodity lines entirely.
Silicon carbide outperforms traditional silicon in high-voltage, high-temperature environments, exactly the conditions inside an EV inverter. SiC chips enable longer range, faster charging, and smaller battery packs.
Automotive now accounts for more than 60% of revenue. Long-term EV supply agreements provide visibility, design wins that are extremely difficult to displace once embedded in a drivetrain.
Trailing 12-month revenue reached $6.1 billion. Q1 2026 came in at $1.5 billion, up 4.7%, the first positive growth in 5 quarters, signaling end of the destocking cycle.
Gross margin sits at 44%, reflective of onsemi's fab-intensive model. The company operates automotive-grade factories in the US, Japan, South Korea, the Philippines, and the Czech Republic.
GAAP operating income was negative in Q1, weighed by depreciation and restructuring. Free cash flow tells a cleaner story: $239 million, a 15.8% FCF margin.
The balance sheet is a genuine strength. $2 billion in cash, negligible net debt, unusual for a capital-intensive semiconductor manufacturer, and a key enabler of continued SiC investment.
The SiC field is crowded. STMicroelectronics, Wolfspeed, and Infineon chase the same EV content. onsemi's edge is vertical integration, direct substrate sourcing, proprietary wafer processing, and a diversified fab network.
On the radar, onsemi leads on SiC position and automotive content. Gross margin is the weakness. NXP, Texas Instruments, and Microchip all run higher on fab-lite or software-embedded models.
The bear case is EV adoption pace. If unit volumes disappoint, revenue stalls even as SiC content per vehicle rises. onsemi carries more automotive cycle exposure than most chip peers.
The bull case, SiC content per vehicle, is still in early innings. Higher voltage battery architectures grow the dollar content of power electronics, regardless of unit volume trends.
El-Khoury's track record matters. At Cypress, he ran the same playbook: focus, prune, win the category, exit at premium. onsemi has followed that script with precision.
The customer base spans 35,000 relationships globally. Industrial and cloud power provide diversification and absorb capacity when automotive demand runs uneven.
The price arc captures the transformation: $20 in 2020, a peak near $80 in 2023 on EV optimism, a pullback through destocking, and now back to 102.
El-Khoury studied electrical engineering at UC Santa Barbara. Fluency that matters in SiC, where substrate physics, not just marketing, determines who wins the design win.
That's the company chapter for On Semiconductor, spun from Motorola, refocused by El-Khoury, and staking its future on the power chip inside every serious electric vehicle. This is Charged Alpha.
On Semiconductor, bet its future on silicon carbide power chips for electric vehicles. Let's see where that bet stands today.
On Semiconductor just posted Q1 2026 revenue of $1.51 billion, the first positive year-over-year growth in 5 quarters. After 8 consecutive declining or flat quarters, the inflection is here. Non-GAAP EPS of 55 cents beat the 45-cent estimate by 22%. GAAP EPS was negative 8 cents. The stock is on, ticker ON. This is Charged Alpha.
On Semiconductor is a leading supplier of power semiconductors and sensing technologies. The company's core product lines are silicon carbide power devices, called SiC, which are the critical components inside electric vehicle drivetrains that convert battery power to motor torque. Automotive represents over 60% of ON's revenue, with industrial applications making up most of the remainder. ON is headquartered in Scottsdale, Arizona.
SiC is a next-generation semiconductor material that handles high voltage and high temperature far better than traditional silicon. That makes it ideal for EV inverters, onboard chargers, and charging infrastructure. ON has won design sockets at major EV manufacturers globally. The thesis is that even as total EV unit volumes disappoint near term, the SiC content per vehicle keeps rising as automakers move to higher voltage 800-volt platforms.
The headline number is the inflection. Q1 2026 revenue of $1.513 billion grew 4.7% year-over-year versus $1.446 billion in Q1 2025. That ends a streak of 5 consecutive quarters with negative or flat YoY comparisons. The 2-year inventory destocking cycle is over. This matters because the market has been waiting for exactly this signal.
On earnings, the GAAP versus non-GAAP split requires explanation. GAAP EPS was -8 cents on a GAAP operating loss of $53.4 million, but that operating loss includes restructuring charges and stock-based compensation, items excluded from the non-GAAP view. Non-GAAP EPS of 55 cents beat the 45-cent estimate by 22%. Use the non-GAAP number for operating performance comparison.
Gross margin came in at 44%. FCF on a trailing 12-month basis is $239.1 million, a 15.8% FCF margin. The balance sheet is solid, $2.005 billion in cash against roughly $3.2 billion in debt. Net debt is under $1.2 billion, manageable relative to the revenue base and improving cash generation trajectory.
The quarter-over-quarter picture is slightly different. Revenue fell 1.1% from Q4 2025's $1.53 billion. That sequential softness in a seasonally strong quarter for auto chips was noted by analysts, but the YoY inflection dominated the conversation. The trend line going forward, Q1 2025 through Q1 2026, is now pointing upward.
SiC socket wins are the forward indicator. ON has announced long-term supply agreements with multiple EV manufacturers, with volumes ramping through 2027 and beyond. Automotive content per vehicle is growing even when EV unit volumes underperform, because automakers are adding more SiC devices per car as they upgrade to higher voltage architectures. That content story is independent of short-term EV adoption rates.
Market cap sits at $42.9 billion, with a price-to-sales multiple of 7.1 times. That is expensive for a company that just resumed 4.7% revenue growth. Texas Instruments trades at 10.6 times PS, but TXN is growing at 9.1% with a cleaner earnings profile. The valuation premium demands consistent execution and SiC ramp delivery going forward.
Analyst consensus is cautious, a hold rating with an average price target of $75. The stock is trading at 102, which means ON is sitting 36% above the analyst consensus target. That is an unusual and uncomfortable position. It means either the stock is overvalued relative to the fundamental view, or analysts need to materially raise estimates as the SiC ramp becomes undeniable.
Bulls on the street argue the hold rating and $75 target reflects stale models that have not fully credited the inflection. If the inventory destocking cycle truly ended in Q1 and SC socket wins convert to revenue at the pace management guides, full year 2027 revenue could approach $7 billion, implying the current multiple is less demanding on a forward basis.
Cautious analysts point to the gap between non-GAAP and GAAP. Ongoing restructuring charges and high stock-based compensation are real costs to shareholders even if excluded from the operating metric. The GAAP operating loss of $53 million in Q1 means the company is not yet generating accounting profit, and until GAAP turns positive, some institutional mandates restrict ownership.
The EV volume debate is the central analyst disagreement. Bulls believe SiC content wins insulate ON from EV unit softness. Bears believe the inventory overhang at Tier 1 suppliers has not fully cleared, and that EV volume disappointments continue to pressure unit shipments, even as design win conversations remain healthy. Q2 guidance will be the key data point to watch.
A specific risk the street is tracking: Wolfspeed competition. Wolfspeed is ON's primary SiC competitor, and Wolfspeed has been aggressive on pricing to gain share as its new manufacturing facility ramps. Price pressure in SiC devices directly compresses ON's gross margin, and at 44%, gross margin is already below where investors want it for a premium-valued semiconductor company.
The bull case hinges on one word: inflection. 5 quarters of negative year-over-year growth followed by positive 4.7% growth signals that the cycle has turned. Semiconductor inventory cycles historically run 2 to 3 years from peak to trough to recovery. If Q1 2026 marks the trough recovery, the next 2 years should see accelerating growth as SiC socket wins convert to volume.
SiC content per EV is the structural driver that makes ON's story different from a simple cyclical recovery. 800-volt EV platforms require more SiC devices per vehicle than 400-volt systems. As legacy automakers migrate to higher voltage architectures, a move that is happening across BMW, Hyundai, and multiple Chinese OEMs, ON benefits from content expansion regardless of whether total EV units miss analyst forecasts.
$2 billion in cash provides optionality. ON can accelerate SiC capacity, pursue bolt-on acquisitions, or return capital through buybacks. The balance sheet is not stretched. If the SiC ramp delivers, 2027 revenue and EPS will look materially higher than current consensus, making today's multiple defensible in retrospect.
The bear case starts with valuation. At 7.1 times price to sales, ON is priced for robust growth. Microchip trades at 3.8 times PS. NXP trades at 3.7 times with similar automotive exposure. ON's premium demands the SiC ramp exceed consensus. Any miss hits a stretched multiple hard.
The stock is 36% above analyst consensus target. That gap resolves one of 2 ways. Analysts raise targets as fundamentals improve, or the stock corrects toward them. With hold consensus and no clear upgrade catalyst, the burden of proof rests on ON's next several quarters.
EV unit volume disappointment is persistent. If major EV markets, the US, Europe, and China, continue to miss volume targets, ON's socket wins sit in design phases rather than production. Content per vehicle growth is real, but cannot fully offset adoption slowdowns.
Wolfspeed's SiC pricing aggression is the competitive trigger. If Wolfspeed cuts price to gain sockets, ON must choose: match and compress margin or hold price and lose sockets. At 44% gross margin, well below TXN's 58 and NXP's 57, ON has limited cushion.
The peer comparison is direct. Microchip Technology, 4% revenue growth, 3.8 times PS. Texas Instruments, 9.1% growth, 10.6 times PS. NXP, negative 4.6% growth, 3.7 times PS. ON, at 4.7% growth and 7.1 times PS, is priced above Microchip and NXP despite comparable or lower growth.
TXN earns its 10.6 times multiple through industrial diversity, a best-in-class dividend record, and an owned fab network. ON lacks those credentials. The gap between ON's 7.1 times and TXN's 10.6 times is the market pricing consistency versus recovery stage execution.
Gross margin is where ON lags. TXN 58%, NXP 57%, Microchip above 50%, ON 44%, lowest in the group. SiC devices structurally carry lower margins than microcontrollers, but the gap is wide enough that ON needs clear margin expansion to justify the premium multiple.
Peer conclusion: ON is the highest leverage EV semiconductor bet in this group. Microchip and NXP offer diversification at cheaper valuations. TXN offers execution history at a higher multiple. ON is the pure-play SiC EV thesis, right or wrong depending on whether EV volumes and socket wins materialize as guided.
Options positioning heading into earnings reflected the cautious analyst consensus. Put-call ratio was approximately 0.80, a slight lean toward downside protection. EV demand uncertainty and the stock's position well above analyst price targets created a hedging environment. The implied move was moderate, and the non-GAAP beat of 22% drove an outsized reaction relative to what options were pricing.
Post-earnings call positioning is muted. The stock's premium to analyst targets creates a ceiling for aggressive upside call buying. Buyers of $100-plus calls need ON to execute multiple quarters of clean delivery before analysts raise targets enough to support those strikes. Downside put activity reflects holders who are long the SiC thesis, but prudently hedging the 36% premium to target risk.
CEO Hassaneh El-Khoury has been a net seller under a 10b5-1 plan. pre-scheduled insider sales are not inherently bearish. Executives diversify accumulated equity compensation through systematic programs. But when the stock is trading 36% above analyst consensus target and the CEO's pre-scheduled selling continues, the optics compound the valuation concern for some investors.
Institutional ownership is the stabilizing force. Large passive holders, Vanguard, BlackRock, State Street, own ON as part of semiconductor index exposure. Active managers are more split. Growth-oriented funds are long the SEC inflection thesis, while value-oriented funds are underweight given the premium multiple. The hold consensus from analysts creates limited upside catalyst unless earnings surprise forces a broad upgrade cycle.
Bottom line, Q1 delivered the inflection, first positive YOY growth in 5 quarters, 22% non-GAAP EPS beat, $2 billion in cash. SIC thesis advancing, but the stock is 36% above analyst consensus with a GAAP operating loss intact.
Watch Q2 gross margin and SIC mix. If both improve, upgrades follow. If not, the premium closes the hard way. On Semiconductor Q1 2026 on Charged Alpha.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.